You're welcome to the Forex Trading and Lifestyle Entrepreneurship channel. Do take a minute to pause this video and read this disclaimer.
Hi there, it's Victor here once again from foreshormarkets.com. In today's video, I will be teaching you about margin and leverage. Okay, understanding margin and leverage is one major key that will keep you as a newbie trader, as a beginner, as a learner from blowing your account. Okay, so what you have most times these days is that you have new traders or newbies who are just learning, and they get excited by the ability to trade one standard lot on maybe $100, $200, $300, $500 account. All right, but without understanding the concept of margin and leverage, they learn the hard way that you cannot abuse margin and leverage even though it allows you trade a standard lot or more. Okay, so in today's video you would understand the significance of margin and leverage and why you really need to get the basics right, and so that when you are taking those big lots trade on small accounts, you know exactly what risk you are taking. Okay, all right, so let's see. So margin and leverage. Margin is a totally different concept from leverage. Okay, so we'll look at them one after the other. Okay, so let's start with margin. So from the presentation here, we see that margin is basically a good faith deposit required to maintain open positions. Okay, in other words, it is not a transaction cost, so you're not charged. Okay, but instead a portion of your account capital or equity is set aside and assigned as a margin deposit. One interesting way to look at it is like collateral. Okay, it's not a fee. Okay, but once you are done with the trade, that margin or collateral is returned to your initial capital. All right. Okay, so let's go a little further into what margin means. Example, say you want to buy you go to your malam or you go to your jewelry dealer or your gold dealer and you want to buy 10 kg of gold. Okay, and if 1 kg, so let's go to my slide. So let's say you want to buy 1 kg of gold. Okay, you want to buy 1 kg of gold, and 1 kg of gold, you want to buy 10 kg of gold. Okay, and 1 kg of gold costs, let's say let's just say $100, hypothetically $100. Okay, so if you want to buy 10 kg of gold, this is going to be what, 1,000 USD. Okay, so the margin that is required for you to complete this transaction is what, 1,000 USD. Okay, I also usually give an example of a local example in the Nigerian market space, where you have, like, example, the traders. Okay, let's say a trader that deals in drugs. Okay, so we're using drugs as an example. Okay, and then a drugs company, let's say a drugs company sells to distributors. Okay, to distributors. Okay, of course you need distributors to sell your products. Okay, so this distributor has been doing business for this drug company doing business with them for, let's say, 5 years, and this distributor has been performing very well, making payments on time, and has been having good sales. And then so the drugs company sees that this distributor is a good customer. So let's say this distributor has been doing a monthly transaction of 1 million naira monthly, monthly. So this is the margin. 1 million is the margin. So he has been putting down full margin, 100% margin before he takes goods. Okay, now after 5 years, the drugs company feels that this distributor is a good company, and they feel they can give them some credit facility, or they can give them, based on trust, give them some ability to purchase more goods. Okay, so what does the drug company do? The drug company says, you have been doing 1 million monthly, so why don't I give you, to increase your sales, let's give you 3 million naira worth of goods, 3 million naira worth of drugs monthly. Okay, but you just give us a payment of just 1 million naira. Okay, 1 million nairas. So this is 3 million naira as well. Okay, so what happens is that the distributor pays the drug company. So drug company pays them 1 million and takes goods worth of 3 million naira. Okay, and then when they are done selling the goods worth of 3 million naira, they pay the balance of 2 million. Okay, 2 million naira balance. So it is a win-win situation for both the distributor and the drug company. And of course, you and I know that so many companies apply these strategies to increase their sales and to retain loyalty with their customers. Okay, now they paid 1 million. So this 1 million, so you can see this 1 million as the margin. Okay, if you were to pay 100% of the margin required, so if we were to pay 100% of the margin required for that 3 million naira worth of drugs, they would have to pay complete 3 million for 100% margin. Okay, but in this case, they're paying 1 million out of 1 million worth of drugs. They're paying 1 million cash. They're paying 1 million cash out of the 3 million. So this is about 33% margin payment. Okay, so 33% margin payment. So the actual margin that they need is 3 million naira to buy to make the full payment. But the drug company says, you know what, pay 1 million now and pay 2 million after you sell, meaning that the distributor pays 33% of the required margin. Okay, this concept also applies in the forex market. Okay, so the current price of, okay, let's look at our trade. Let's look at this trade. We bought one standard lot of euro dollar at 1.12842. Take note of the margin here. This is margin. You can see that we need $1,128.42. Okay, you can see that this margin here is similar to the price. Now let me explain to you why it's so. So let's look at the price where we bought this euro dollar, 1.12842. Okay, so euro dollar by 1.12842. You want to buy one standard lot, 1.0 lot. This is equals to 100,000 units. I don't joke with this class. When I was learning this, I had a lot of headaches trying to understand and grasp this concept about 14 years ago. Okay, and that is why I'm able to pass it on, in very, very, very simple terms. This is one of the most important classes you need to go through as a trader. If you missed this if you miss your pip, your lot size, and your margin and leverage, it's going you missed the bulk or the core of understanding your risk management and your profit calculation. And of course, if you do not know your risk management and your profit expectation or your loss expectation, then that is a disaster waiting to happen. Okay, now we are taking the concept of units further. 100,000 units simply means for me to buy euro dollar, 100,000 units of euro, okay, using the dollar, okay, at the exchange rate of 1.12842, I need to buy 100,000 units of euro. I need what? 100,000 units times this. Let me see, where's my calculator? 100,000 units. I don't need adverts now. Basic 100. Where the hell is my delete button? Okay, I found it. Okay, so 100,000 units times 1.12842 times 1.12842. Okay, that gives us 112,842. 112,842 USD. That is what you need. You need $112,842 to buy 100,000 units. Why? Because of this exchange rate. Because 1 euro equals to 1.12842 USD based on this exchange rate here. Okay, so that is why I'm saying we are taking the concept, this concept here of your units, we are taking it further to understand the significance of your unit in your pip value, your dollar per pip value, and your profit calculation, and then also in your margin and your leverage calculations. Okay, I'm going to spend a lot more time on this video, probably up to 30 minutes, so you can get the concept. Okay, so we need, for us to pay 100% margin, okay, we need to pay 112,842 USD to buy 1.0 lot of euro USD pair. Okay, in other words, it simply means we want to buy 100,000 units of the euro using the dollar. This is what you need. Now, this is the margin you need. Margin. So this is the meaning of margin. Let's deal with margin first. Okay, so margin required to buy 100,000 euros is 112,842 US dollars. That is your margin. So now let's look at the definition for margin. Margin simply means basically a good faith deposit required to maintain open positions. It is not a fee or a transaction cost, but a portion of your account equity. Let's leave this for now. Let me give you a layman's definition of your margin. Margin is simply means the worth of what you are buying. Okay, margin simply means the worth of what you are buying. For you to buy 1 euro, for you to buy 1 euro, you need, for you to buy 1 euro, you need $1.12842. So the margin required for you to buy 1 euro is $1.12842. That is just the worth of 1 euro. So if you want to buy 1 euro, be ready to provide this amount in dollars. If you want to buy a 1 kg of gold, there is an amount you need to pay to be given. Okay, let's use naira. You want to buy 100 US dollars using naira. Right now you probably need to pay 44,000 naira to get $100. The margin required to own $100 is 44,000 naira, simply meaning that is the worth of $100. So in Forex, everything you buy has a value, and that is the simple definition of margin. Now leverage comes in. Why does leverage come in? Leverage comes in because very few individuals can afford 112,842 US dollars to buy. Okay, let's use my mouse now. To buy 112,842 US dollars to buy 100,000 euros. Okay, to buy 100,000 euros. If that is the minimum trading size, most people will not be able to trade Forex. Okay, now let's look at the smallest lot size. The smallest lot size is 0.01 lot. Okay, now remember, this is 1,000 units of 1,000 units of euro. So for you to buy 1,000 units of euro, you need, let's look at that calculator again. This time 1.12842 times 1,000. You need 1128.42 US dollars. 1128.42 US dollars. This is the margin required. Okay, that means the minimum requirement for anyone to start trading the smallest lot size in Forex would have been this amount. And then those who want to trade one standard lot, which is 100,000 units, would have to pay 112,842 USD. Very few traders right now can afford this amount. This is where the concept of leverage comes in. Okay, probably I should do that in a second video. Okay, I should break that into a second video. Okay, so let's leave this as margin. So this is your margin required to purchase 100,000 units of euro. This is your margin required to purchase 1,000 units of euro. Okay, so let's leave it at this. To purchase 0.01 lot, which is equals to 1,000 units of euro dollar, you need a margin of 1128.42 USD. 1128.42 USD to buy a mini lot. So this is micro. To buy a mini lot of euro USD, that's 0.10 lot. This is equals to 10,000 units. You need 10 times of this, which is 1284.2 USD. This is the margin required. And then to buy a standard lot, which is 1.0 lot, which is equals to 100,000 units, you need 112,842 USD minimum capital base. Okay, so meaning that this is for you to trade one standard lot on a regular, this is what you need. But thank God for leverage. Okay, leverage is what helps you cut off these large amounts. Leverage is what allows you to use a small amount of capital to purchase sometimes 10 times, 100 times, or 1,000 times more of what you would have ordinarily bought without leverage. Okay, of what you could have bought, Okay, so let's leave this video as margin, and then I'll do the next video and explain leverage further. So look at this number here. We bought one standard lot at that price. The price was 1.12842. Okay, so let's look at the MetaTrader 4 and look at the margin. What is the margin? Look at my mouse pointer. You can see the margin here. Margin is what? 112842. This amount has been set aside from your total equity, of which is 100,000. So you now have left 98,741. Okay, because this is what you can use to buy other currency pairs. Without leverage, you would need $112,842 to make the same purchase. So in the next video, you will see how leverage has made this possible, to use smaller capital to control larger, to make bigger transactions. Okay, so if you've learned something new in this video, give us a thumbs up, and also make sure you subscribe to the channel. If you are yet to subscribe, click the subscribe button below this video, and also click the bell beside the subscribe button. Click all notifications so that you will be notified whenever I upload a new video. Okay, go back to the beginning of this video, watch it several times until you understand this concept. It is extremely important. Watch this video, watch the next one on leverage, and I can assure you you'll be well grounded on margin and leverage, and understand why you need to be careful with your lot sizes so as not to blow your account. Okay, I'm sure this is already about 20 minutes. I've gone a long way, so that's why I decided to cut it at this point. So I'll see you in the next video. Have a wonderful day.